Hi, everyone. This is Jen Appel. I'm a senior investment director on the asset allocation team at NEPC. And so here we are just at the beginning of 2024, which from a political standpoint has almost the stars aligning in terms of the number of national elections that are occurring around the world this year. By our calculations, it's just over 50% of the world's population that'll be heading to the polls. So this global election super cycle, if you will, against this backdrop of elevated geopolitical tensions, can certainly widen the range of outcomes for all of the elections that we're going to experience and policy. So we'll be closely monitoring the potential impacts from a capital market standpoint throughout the course of this year. But for today, we are hoping to focus on the US elections, which are currently about 10 months away. So this may seem a little bit early to start talking about the election, but we wanted to get some thoughts and implications out there for investors as we begin this year that is set to be an interesting one from a market's perspective, with the caveat that things will likely change and evolve throughout the course of 2024. So I'd encourage you to check back on our website for further updates as we approach Election Day. But a few thoughts to kind of kick us off today. First, that election outcomes are important for a variety of reasons. But as we think about capital markets over the long term, individual election outcomes are less important than macroeconomic factors in terms of what the prevailing growth and inflation regimes are, and also what monetary policy environment we're in, as those tend to drive long-term market returns, even fundamentals, and also, importantly, investor sentiment. So elections, of course, matter, but they're not the driving force behind long-term market dynamics. And I alluded to this already, but 2023 was a really formative year in many ways. And a lot of the market dynamics from this past year are going to have an influence on the 2024 elections. In particular, this backdrop of elevated interest rates works to kind of challenge the fiscal outlook for the country as rising interest costs are applying further pressure to the expanding deficit, while at the same time, there are still concerns around inflation and also the likelihood of a recession that have elevated the economy as a key election issue, which I'm sure we're going to be hearing a lot about on the campaign trail. And while a lot of the focus will be on who is ultimately elected to the presidency, we believe that the most important and relevant outcome for investors is whether or not there's a divided government, given the potential policy implications that holds. And the fact that ultimately a divided government can offset market concerns or even market enthusiasm related to one specific candidate's policies. Now, we're going to dive deeper on all of these aspects, but the key takeaway here is that elections shouldn't dictate shifts in portfolio allocations. This is one of those times that we really want to stay focused on long-term investment objectives, to look at those strategic targets that were put in place from a governance perspective when times were calm, and not to deviate from that. With that said, as we've said in previous election cycles, we will be looking for rebalancing opportunities that might come about around key election dates, but that long-term focus is really the key here. So with that backdrop in mind, we'll just briefly run through some of the details around the election, which is set for November 5th later this year. What's at stake this time around? We have the presidency, the entire House of Representatives, and about a third of the Senate. The country currently has a divided government, with the House narrowly controlled by the Republicans and the Senate narrowly controlled by Democrats. Just one thing of note, there are 34 Senate contests on the ballot this time around. 20 of those seats are Democratic that are up for re-election. But of those 34 races, there are only a few that are actually deemed to be competitive. So that's where really all the attention is going to be focused. So ultimately, we have here control of the House, control of the Senate, and the presidency all being up for grabs in 2024. Now, every election, it seems, we turn our attention to the battleground states, and this election cycle is no exception. What's interesting this time around, the census, which takes place every 10 years, occurred in 2020. And that's going to play a role in these elections as electoral votes and congressional seats are allocated among states based on the census results that reflect changes in population. So we have a few states here who actually gained electoral votes. Texas notably added 2. While California and New York, among other states, have lost votes. So this will, by nature, shift the composition of the Electoral College. With that said, we have a number of battleground states listed on screen here, along with the number of electoral votes for each state. The winning candidate must receive 270 or more electoral votes. So the states that we have here are of critical importance on that path to presidency. Notably, as we look to the polls in each of these states, at the moment, they are favoring Republicans, with the exception of Michigan. And if we actually take out the third-party candidates from that ballot, Michigan is also polling Republican. Now, I think we're all aware of some of the pitfalls associated with political polling, especially with so much time leading up to the election. But these states are likely going to be key focus areas for the Democrats this year, just given where they're currently shaking out. Now, looking forward, we are still fairly early on in the process, but we expect that by mid-March, the final nominees from each party should be clear. Certainly things can change, but as of now, it looks like the 2024 presidential race will likely be a repeat of 2020, with it coming down to current President Joe Biden and former President Donald Trump. This rematch is interesting for a number of reasons, but from more of a historical perspective, it would be the oldest pair of candidates to date, as Biden's the nation's oldest president and Trump was the nation's second oldest president. But this would also be the first rematch between presidential nominees since Eisenhower in 1956. As I mentioned, this is unique for a number of reasons, but as we look to the favorability ratings across candidates, approval ratings across the board are near all-time lows. This dynamic has become more prevalent in the last few presidential elections, which I think highlights the growing political polarization in the country. But for Biden, his approval rating has been declining given some of the frustrations I mentioned over inflation and the economy more broadly, which influences consumer and business sentiment, but also more recently, his handling of foreign policy decisions around China, Ukraine, and Israel. While for Trump, there are outstanding concerns around his efforts to overturn the 2020 election results, some ongoing legal issues, and more recently, he has been disqualified from state ballots in both Maine and Colorado, which will likely end up with the Supreme Court determining his eligibility to run for president. And while all this is reflective of widespread frustration among voters, this has given some credence to this idea of a unity ticket candidate, which just means that there's a third-party candidate that could potentially appeal to voters across the political spectrum and ultimately take electoral votes away from these other candidates. While this idea has gained some traction, history suggests that third-party candidates have difficulty achieving a meaningful number of votes. But the concern here is that, should this person gain momentum, it can influence the election outcome by drawing voters away from Trump or Biden and influencing the path to 270 electoral votes. So that's something we'll certainly be watching throughout the course of this year. Now, turning to a few key election issues, I've mentioned that the economy is ranked among the top issues for voters this year, likely reflecting the toll that higher prices and just general uncertainty around the trajectory of the economy have had on voters. And, you can see that impact whether you look at business or consumer sentiment metrics that remain fairly challenged despite the US economy defying expectations in 2023. Now, as we think about the candidates' stances on each of these issues that we'll walk through, we're likely going to see similar policies to their first terms, but the ability to meaningfully push forward their agendas will come back to that question around a divided Congress. So with that in mind, as it relates to the economy under Biden, we would expect that he would try to build on some of his legislative accomplishments like the CHIPS Act or Inflation Reduction Act that are focused on domestic public investment in manufacturing and clean energy. We also anticipate a renewed focus on those areas in addition to healthcare and education, which are other areas that he's pledged to support. For Trump, he will likely remind voters of the positive economic momentum that was achieved pre-pandemic through deregulation and through tax policy that saw corporate and individual tax rates reduced. So he'll be looking to build on some of those pillars. As a note, we are expecting that taxes will be an important issue to the election overall, given that the Tax Cuts and Jobs Act that was signed by President Trump in 2017 has many provisions that are set to expire in 2025. However, when we think about the current fiscal backdrop, regardless, we believe that taxes are set to rise over the course of the next decade as the deficit continues to become a larger issue and the government needs to kind of fund that gap. So the tax piece is an important one for investors as it can have a pretty meaningful impact from an individual or a corporate standpoint. Generally speaking, if we see taxes increase, that should make tax deferred investments more favorable, and it can kind of push taxable investors away from more income oriented areas that may look less attractive on an after tax basis. So that'll be something to watch out for. Moving to another key issue, foreign policy has jumped near the top of the list for voters amid this backdrop of elevated geopolitical tensions. One key aspect of foreign policy will certainly be around US-China relations, which, as we're all aware, is not a new election issue this time around. But this is an interesting area where views from both political parties have converged. Policy has been relatively stable between the Trump and Biden administrations. But with that said, we would expect that Trump would be a little bit harsher in his stance toward China in terms of tariffs or other tactics that Biden hasn't expanded on during his term. And beyond that, we have the ongoing wars in Ukraine and Israel that have driven some disagreement on the US response and involvement. The Biden administration has pushed for funding both Ukraine and Israel, which has been contentious among voters. In contrast, as we think about Trump, his foreign policy platform has been more isolationist in nature. He's even stated that he would end the conflict in Ukraine, so we can expect likely less US involvement in these conflicts under Trump. Next, we have immigration that has quickly escalated as a very important election issue as the number of unauthorized migrants to the country has accelerated to record levels as of late. For Trump, immigration was a cornerstone of his first term, and he has advocated for even stricter immigration policies than that first term. So this will likely be a central issue to his re-election bid. And we anticipate that he'll push for finishing the US-Mexico border wall and imposing asylum limits, among other things. For Biden, he has sought to discourage unauthorized entries into the country and has even accelerated deportations. However, public disapproval of his handling of the migration situation is high. And beyond that, one social issue that has risen of critical importance to voters is abortion rights, which are now near the top of the list following the 2022 Supreme Court decision that overturned Roe versus Wade. Trump has yet to take kind of an official stance on supporting a federal abortion ban or not, but his Supreme Court appointees were an integral part of the Supreme Court decision, whereas Biden is pro-choice and supports women having access to abortions. So Democrats have really tried to leverage their position on that issue in key states, and this is one aspect that likely fed to the Democrats' strong performance in the 2022 midterm elections. So we expect that they will continue to build on that. Now, switching gears a bit, we want to explore the intersection of elections and capital markets. And I'm sure the quote that comes to mind for many is, "It's the economy, stupid," from Bill Clinton's campaign in the 1990s, which is still applicable today. When it comes to kind of the long-term trajectory for the economy, The business cycle is dictating economic growth and inflation rather than the party or individual in office. The economy, as you can see, has continued on this growth trajectory regardless of which political party is at the presidency. With that said, there are certain pockets of the economy that are more sensitive to the election outcome, given the potential policy implications that holds. In particular, as we think about regulatory policy, which tends to be a little bit more split by political party, in that Republicans generally favor less regulation overall. So one way to see that impact is on small businesses. Small business optimism tends to be really sensitive to more restrictive tax and regulatory environments, and changes in the regulatory environment ultimately flow through to economic activity as a result, because it can influence hiring decisions or capital expenditure decisions for these businesses, among other things. But there are some other sector aspects here as well, whether in the financial sector or energy or healthcare, they all may be sensitive to some of these dynamics as well. Now, I've mentioned the impact of elevated inflation on this election cycle, which feeds into this idea of economic misery. And this measure is just the sum of the inflation rate and the unemployment rate. And it's typically thought to measure economic discomfort. And typically when this misery rate is elevated or it hits a peak level, that has historically led to an incumbent president losing office as voters feel the impact of inflation, or they have more difficulty in the current job market, or even some combination of the two. So this relationship did hold true in 2020, shortly after we saw the peak in unemployment from the pandemic that drove this measure higher, and then Trump lost the election. But since then, with the inflation dynamics that we've had under Biden's presidency, this measure has once again become relevant and has risen, even though it has since declined. But this could still be influential given the prevailing more negative consumer sentiment that I've mentioned. And despite the fact that inflation measures continue to moderate, prices still play an important role at the polls for consumer. We often see a lot of focus on gas prices, for example, during an election, that can sway how voters are feeling. But as we look to consumer inflation expectations, we see that oftentimes when inflation expectations are rising, that leads to a desire for change, whether or not inflation is directly controlled by the president. And today, inflation expectations are higher than what we saw at the start of Biden's term. So another thing that could potentially have an impact. Now, looking to some market metrics, we've historically observed that the behavior of the stock market in the 3 months leading up to the election has been a fairly good predictor of the election outcome, with surprisingly close to a 90% hit rate when looking at historical elections. Specifically, when the returns on the S&P 500 index were positive in the 3 months leading up to the election, that signals a high likelihood of the incumbent party winning. Well, if the index is negative in the 90 days beforehand, the incumbent will tend to lose the election. So we'll have to kind of keep this in the back of our minds as we head into early August to see if this relationship holds true once again. With that said, markets really don't see red or blue. Oftentimes, we are posed with the question, what political party leads to better market returns? And when we look to historical presidential terms, there's not a very strong relationship between political party and market returns. Democratic terms have been slightly stronger over the long term, but it's important to note that these charts are really time period specific, and that the market environment coming into a presidential term is much more influential than which political party wins, which you can see in some of the large negative and positive bars on the chart surrounding recessions or peaks and troughs in the business cycle. So as I've mentioned throughout this presentation, one of the key aspects from a capital markets perspective is the prospect of a divided government. You can see, looking at these returns for a one-party sweep relative to a lot of these other mixed combinations, gridlock is good for markets. This is just a reflection of less likelihood for sweeping policy changes and more likely a preservation of status quo. So ultimately, less regulatory and policy uncertainty associated with these outcomes, and that's favorable from a market's perspective. Now, finally, given the shift in interest rate backdrop and the influence that the Federal Reserve has had on markets, we wanted to just look at historical Fed moves in election years, especially as the market continues to price in an aggressive path of interest rate cuts in 2024. What we find historically is that interest rate movements during election years haven't been meaningfully different than non-election years. But with that said, as we look to the months leading up to an election, which are shown in the light blue bars here, we observe less movement overall. So we don't think that this will change the course of monetary policy next year or this year, given the Fed's stated political independence, but this could impact the timing of those cuts later this year. So to bring that all together, there are a lot of interesting aspects to the 2024 elections that could introduce some near-term volatility to markets. With that said, we continue to believe that the economic backdrop and the monetary policy environment will be the most important factors for long-term returns. And with that in mind, we really encourage investors to focus on their core investment objectives and to capitalize on portfolio rebalancing opportunities that could arise around key election dates. So with that, thank you for listening today, and we look forward to seeing how the election evolves throughout the course of this year, and we'll continue monitoring the implications for investors. Thank you.